Okay. Now chapter 9, which is on PPE. Now, I believe we're all familiar with PPE, right? I believe we are familiar with PPE. I'm not asking you a question on PPE. I'm just saying it's my belief that you've all heard of PPE before and you are
Yes, sir.
familiar with
Yes,
it.
sir.
One and not fear. We are just discussing. I'm not saying you should go into PPE for us. Now, PPE, property, plant, and equipment, right? Don't forget we've been dealing with our what do we call it? IAS and IFRS, right? Standards. And of course, we have to look at the uh recognition, measurement, right? Presentation and disclosure. Okay, now we have for PPE. Of course, PPE are tangible assets that are held for production or supply of goods and services. All right. They can also be held for rentals to others. No, that's tangible assets generally. And don't let me say that. So tangible assets generally are held for production and supply of goods and services, right? For rental to others, for administrative purpose, right? And they're expected to be used for more than one accounting period. Yeah, that's PPE too. All right. Yes. We use PPE for production and supply of goods and services. We rent out PPE. We also use it for administrative purpose, right? Now, we have something called bearer plant that is also classified as PPE. Now, bearer plant is used in production of agricultural produce. Okay? Production of agricultural produce. Then, of course, it is expected to bear produce for multiple periods. You know what the bearer plant is? Plant that produces farm produce, right? Yeah, a plant that produces farm produce, right? Aha. So that's a bearer plant. Uh, I think we have an IS, right? Also, which is under agriculture, right? Where we have biological assets. Am I right? For those of us who are familiar, we also have it to be biological assets. I mean,
Yes, yes.
okay. Then they are expected to bear produce for multiple periods, that is fruits and other farm produce. And it is not intended to be sold except as scrap. Except as scrap. So bearer plants are different from what's it called? Biological assets. Biological assets, you sell them, right? But these ones are not intended to be sold except as scrap. This one, you intend to keep multiplying them. And I think I can use an example of, who has an example? May I have an example? Who has an example of this bearer plant? So I'll use
Cocoa, cocoa,
eh?
Cocoa.
cocoa plantation.
What do you use cocoa for? So you don't intend to sell cocoa?
Yes, can use it for cocoa now. Cocoa to make Bonvita, chocolates.
And it will be producing that in for a multiple period of time. So I'd
Yes,
rather
sir.
use this thing. What do you call these chickens that lay egg? Layers. When you have layers, right? You are not rearing them to sell them. You're rearing them so that they can produce eggs for multiple times. Is that not so?
Yes, yes.
So that is it. You don't intend to sell them. For a cocoa now, you cannot be using the cocoa in your house. You have to use it to produce something. That means you're using the cocoa itself. But the tree is the bearer plant, right? Yeah, the tree is the bearer plant. And that's it. Now, for assets, for PPE, right? PPE is recognized, the recognition criteria now is that you recognize PPE when the cost can be measured reliably and a future economic benefit, there's probability of future economic benefit to the reporting entity, to the entity that owns the PPE. Are we there? Are we there, please?
Yes, sir.
Yeah. So there is a future economic benefit. There's probability of future economic benefit to it, and the cost can be measured reliably. All right. So that's it. Now, also, the significant parts of it must be depreciated separately if it is material. Significant parts must be depreciated separately. Right? Yeah. That is PPE. Now, that's for recognition criteria. Now we have the measurements. How do we measure PPE? We measure PPE at either cost or what? Fair value. Abby? Is anyone there?
Yes,
Yes.
sir. Yes,
Okay.
sir.
So now for fair value, for cost. Now for cost, PPE is recorded at cost, which is the historical price. Historical cost.
Yes.
Am I right, please?
Yes, sir.
Aha. So for the historical cost, you record the purchase price. That's the historical cost, less any discount. Now, this is also what do we call it? The cost of an asset. How to measure the cost of an asset? When you have an asset, how do you measure it? Right? So we have the cost, okay, which is the purchase price, less any discount or rebate. Okay. Then, if there's any other direct costs, what are these direct costs? The direct cost of bringing the asset to a usable condition, including delivery and installation costs. The cost of bringing the asset to a usable condition, including delivery and installation costs. Then also, if there is, are you sure it's not done this thing? If there's any cost that will be incurred in dismantling that asset when it is done, when it is completely used, right? Then that is also a cost that will add to the cost of the asset, initial cost of the asset. Now, for exchange of the asset, we can measure it at fair value unless the exchange lacks commercial substance or fair value is not measurable. Are we there?
Yes, sir.
Now, you have to use a fair value for an exchange asset. Use fair value of assets given up, right? Unless the one you received is more clearly evident. All right? Unless the asset you exchanged it for is clearly evident that it is more expensive than the one you got, right? Are you there? Are we there, please?
Yes, sir, we are here.
Okay.
Can hear
So
you,
that's
sir.
it. Now, if you can't measure it at a fair value, then use the carrying amount. Okay? Use the carrying amount. And what is another name for carrying amount? Eh?
That's net book value.
Net book value. Right?
Yes. Yes.
Net book value. So that is it. Now, subsequent expenditure on an asset. Now, for subsequent expenditure, if you incur any other expenditure, right, that enhances the performance of the asset, subsequent expenditure that enhances performance or extends the life of the asset or replaces a part of the asset, and such costs should be capitalized. Are we together, please? Such costs should be capitalized, and that's it. Now, if it is just a routine repair and maintenance, then it must be expended or expensed. Now, if there is a major inspection of the asset, major inspection of the asset, right? Now, you have to capitalize it if the criteria are met. That is what criteria? That is, if that major inspection extends the life of the asset or enhances the performance or replaces a part. All right. So that is what we have there. Are we together? Are we together, please?
Yes, we are. Yes, sir.
Yeah.
Yes, we are.
So that is it. All right. So that is it. Now, what again? What again? What again? Now, measurement after the initial recognition. So for the initial recognition, we have only one measurement, which is the cost model, because that's the historical cost. Now, it is the subsequent measurement that you have either cost or revaluation. Now, for the cost model, you are using your historical cost less depreciation. And this depreciation is like accumulated depreciation. Historical cost less depreciation. Are we there? Eh?
Yes,
Yes,
please.
sir. Yeah, yes.
Historical cost less depreciation, right? So that's it. Now, the historical cost is the cost of purchase. Abi, am I right? Nobody's talking.
Yes, you are right. You are
Historical
right.
cost
You're
is the-
right, sir.
Oh, you are muted.
Who is muted? Me.
We now, we. So
Oh,
sometimes,
okay.
so
Me,
we
I
don't
don't want you
disturb
to
you.
mute. I like all of us to discuss. That's why I don't want you to mute. Now, the cost is the historical cost less depreciation. Now, in the second year, it will not be just the depreciation for the year. It will be the accumulated depreciation brought forward and the depreciation for the year. Do you understand? So that is it. Now, all assets in a class must use the same model. So if you are using what's it called, cost model for your land, all the lands should be cost models. If you are using revaluation, all of them should use the same thing. All right, now that's what we have there. Now the key depreciation term is that for depreciation, of course, we know depreciation is the reduction in the value of the asset, right, as a result of wear, tear, and usage. Am I right? It's a reduction in the value of the asset
Yes, sir. You're right.
as a result of wearing, tearing, and usage.
Yes.
That's depreciation. Now, depreciation is a systematic allocation over the useful life. The depreciable amount is the cost minus residual value, right? In tax, we call it cost minus tax written down value. Am I right? For your capital allowance. Is that not it?
You're right.
Now, we also have the residual value, which is the estimated amount recoverable at end of a useful life. Residual value, right? Oh, sorry, that's not cost minus residual value. Residual value is not tax written down value. It is not, please. Yeah, so your residual value is the amount that you will get at the end of the lifespan of the asset, if the asset can still be disposed, right? And that's it. Then also we have useful life. Of course, useful life is the expected life of the asset. Am I right? Right?
Yes, sir. You're right.
Okay. Now, we have the carrying amount, which is the net book value. Now, net book value is your carrying amount, which is the cost minus the accumulated depreciation and depreciation for the year. Right? Accumulated depreciation and depreciation for the year. That's it. Now, or if you have impairment, of course. So the depreciation rule begins with when the asset is ready for use and ends when the asset is derecognized. You start depreciating the asset from the date you purchase the asset or the date you start using the asset, whichever is later. Then also ends when the asset is derecognized or classified as asset held for sale. Classified as asset held for sale. Then also, depreciation continues even if the asset is idle. I hope you understand. Depreciation continues even if the asset is idle. Shall we proceed?
Yes, sir.
Okay. Now, your useful and residual life has to be reviewed annually. How do you review it? How do you review it? You call in an expert to give you the price, to give you the current market price. All right? That's it. Now, the depreciation method, you change if pattern of benefits changes as well. And that will be for prospective, right? Now, prospective means that how you apply it. So that's it. Now, your depreciation method is your depreciation method. Okay? Yes. Now, the revaluation impact when you are using a revaluation method, your revaluation can be, okay, it's like when someone goes to the market and they tell you that the value of this thing has increased, or it has changed. It is no more that price anymore, right? So if it's no more the price, it's not it has increased in value or reduced in value. It's as simple as that. Is either it has increased in value or reduced in value. That's for depreciation. I mean, that's for revaluation, right? So if it increases in value, then you have a revaluation surplus in equity in other comprehensive income, right? Unless it reverses a prior decrease in P&L. Unless if in the previous year it reduced in value and this time around it increased. So in that case, that's what you do. If not, you record it under your OCI, other comprehensive income. Now, if it reduces in value, then you record it in your P&L, unless it reverses a prior increase in OCI, and that is that. Depreciation after revaluation is based on new value. You will not be using depreciation and be using revaluation. Hello? You are using depreciation. Now your net book value. Is it that you are using depreciation and getting net book value, or every year you are getting the revaluation method and giving us revaluation surplus or deficit, which will replace your depreciation? I don't know if I'm making any sense there. Am I? Am I? Am I making a sense?
Yes, you are.
Okay. Now, when you have revaluation surplus in realization, revaluation surplus realization, when you realize a revaluation surplus, now this may be transferred to retained earnings when asset is sold or depreciated. All right, so that's it. When the asset is sold or when the asset is depreciated, your revaluation surplus is transferred to retained earnings. Now, the judgment area for IAS 16 requires estimates and judgments. I mean, IAS 16, your what's it called? Depreciation method and all of that, all those things are judgments and estimates, right? Now, IAS 16 requires that estimate and judgment. It requires estimate and judgment when you want to capitalize some of your costs. So which means there are some of the costs I can capitalize in my own end. And in your own end, you expense it. And you have a justification for it. And the two of them will be valid because it's an estimate. And accounting standards permit estimates, right? Then also, treatment of subsequent expenditure as well. When we say some of them can be capitalized, some can be expensed, right? Or some can be expended. The two English, then go. And they are correct. Either they are expensed or they are expended. Two of them is correct. So treatment of subsequent expenditure as well can require an estimate and judgment, right? Now, componentization for depreciation. That is to divide depreciation into components. Yes, that also requires estimates and judgment. Then choosing depreciation method, of course, that one is a primary estimate itself. Now, estimate of useful life and residual value. Now, would you believe that there are some companies that their their furniture and fittings is also 4 years. Ordinarily, how many years is furniture and fittings? Ordinarily, how many years should it be?
5 years. 5
Furniture and
years.
fittings, right?
5 years.
Yeah, 5 years.
Are you sure?
What's the
Eh?
capital allowance? So,
What do you say, man?
It's,
it's
it's 5
5 years.
years.
It's 5 years, sir.
Are you guys doubting
It's
it?
5 years.
It's
It's
5
5
years.
years.
Me, I'm asking. Are
It's
you
5
guys?
years.
And me, I'm not
Yes,
doubting
sir.
it. I'm asking if you are doubting it. Me.
No, I'm not doubting. It's 5 years.
Okay. So we already agree it's 5 years. Okay. Yes, 5 years. Furniture and fittings, 5 years. Furniture and fittings, 5 years. Right? And you will get that in your, what's it called? Capital allowance. Very well. Okay. Now, furniture and fittings is 5 years. Some companies still make their own 4 years. Would you believe that? Some companies, 4 years. So which means, and if it is in their company policy, then that is it for them. So which means if I'm using 5 years, you are using 4 years, it's an estimate, and two of us are valid. Right? It is only in capital allowance we can't do whatever we like. So that's it. Then also selecting measurement model, whether you are using cost model or revaluation model, is an estimate. Whatever you like, you can use. And also classification of assets into appropriate classes is also subjective. Yes, it's subjective. Now, some people will record AC under furniture and fittings. Some will record it in equipment, plant and equipment. Do you understand? So anyone you put it, just make sure it's in your company policy and you are consistent with it. Now, you can always change your company policy now, Abby. Are we there?
Yes, sir. We're here.
Yes,
We're
sir.
here.
Good. Okay. So that's it. Now, that's that on IS 16. Let's go into IS 40, which is investment property. Now, investment property has two attributes, two characteristics. And those attributes is either one of them or the two of them together. All right? Now, investment property can be a land or building or both of them. Right? It is an asset that you are holding. It's not only land and building, no. Motor vehicle can be an investment property, oh. Plenty things like that. Now, investment property is anything you have. You hold it, right, in order to earn a rental income or to increase the capital, to appreciate the capital, that is the cost of that asset. Right? Any asset you have for the purpose of getting rent from it or to increase the value of that asset or both of them, then that is an investment property. All right. Now, I said not only land and building. Can we have another example from anyone? Can we have another example?
Plant and machinery.
How? Give us an example. Explain it, please. Can you please explain? Hello?
Okay, when the plant is being repaired, or when there is, especially in some industries or factories, they may like to expand the speed of the machinery. They may like to, in order to do that, there are some features that will be installed in the factory to aid the machine to be working faster or to increase the output.
I know that one, if you are increasing the output, that one is what do we call it? That's a capital expenditure. That one is a capital expenditure. That one is not. You are saying that you have the machinery, you have to collect rent from it, to rent it out, or to increase the value, the capital, and the cost, the market value of the machine, not to increase the capacity of the machine. Now, there's anyone with a question?
Motor, what about motor vehicle? Like you
Yeah.
acquire them for transportation, like how you have GUO and GIG.
Mm.
It,
Do you
it
rent
can
it?
it
Do you rent
also
GIG?
qualifies. Is it not to it people okay, sorry, for car hire, like people hiring the cars, you know,
Uh,
car this thing where you go and hire a car maybe to travel to this place and it brings in income.
hiring.
Qualify. Yes.
Can we take hiring as rent?
Yes, sir.
Thank you. You can hire a car. It can be on even lease. Even lease is also rent, right? So motor vehicle is a very good example. So leave that GIG or the rest. Some people rent motor vehicle for their wedding. Some people
Yes.
rent motor vehicle for like limousine,
Okay.
right?
Hmm.
For photo shoots. I mean, for video shoot and all of that. Now, when the purpose of buying that asset is just to rent it out or to increase the market value of the asset, then that is what we call what? Investment property. All right. So that's it. I hope we can proceed.
Yes, sir.
Okay. Now, investment property is not property you hold for production or supply. All the definition of IAS 16, where you hold it for production in order to be producing inside, like factory, right? Or where you use it for administrative purpose, or where you sell it. That is like real estate now. Investment property is not real estate, oh, whereby you are into buying and selling of houses. That one, your property, that house you have is real estate. Oh. Are we there?
Yes, sir. Yes, sir.
Uh-huh. So real estate is an inventory, not investment property. Now, how do you recognize it? You recognize it the same way as IAS 16. All right. And what is that? When there's probability that there is future economic benefit, and the future economic benefit will flow into the reporting entity, and also the cost can be measured reliably. All right. So that is it. Also, for the initial measurement, you measure it at cost, which is your purchase price, and directly attributable cost, which includes the legal fee, the property transfer taxes, all the taxes involved. All right. So that is it. Now, for leased investment property, we have IFRS 16 to determine the initial cost. That is for lease, Abi. So for lease now, we have right of use. Am I right? Right of
Yes.
use of assets.
Yes.
So that's it. Now, for subsequent measurement, you have either the fair value model or the cost model, right? Now, the fair value model is that you revalue the asset every year, get the market value or the fair value. All right. Now, then if there is any gain or loss, the gain or loss, we go to the P&L account. And of course, this is investment property, right? There's nothing like depreciation. There is nothing like depreciation for investment property. And that is that. Now, cost model. Cost model is the same thing as IAS 16, where you have your cost less accumulated depreciation and impairment. Then it is used only if your value cannot be measured reliably. Now, when you choose any model, you must apply it to all your investment properties, and you can't change it unless it leads to a more appropriate presentation. All right, so that's it. Now, example of investment property. We have land held for long-term capital appreciation. Yes, you can buy land and keep it. Right? So that's it. Now, you have land with future undetermined use. You bought it, you don't know what you want to use it for. You just bought it. Are we there?
Yes, sir. We're here.
Now, when we have building as well that is leased out under operating lease, operating, not financial, operating, which is under a year, not more than a year. Abby, am I right, please?
All right.
Okay. Now, we also have property under construction for future investment use. Future investment use. All right. Now, transfers. When you transfer your investment property to either PPE or to what do we call it? Inventory, or to asset held for sale. Now, a situation like that, when you transfer either from or to investment property, right? Now, this one is only when there is a change in the use backed by evidence, not just the intention. You transferred it for real. You're not using it for rent again. Instead, you are using it for administrative purpose, which is PPE, or for production, or for inventory. You started selling cars. Are we together?
Yes, sir.
That's what we have there. Now, example is that owner occupation begins. Right? So that's it. Now, we also have development that starts for sale. When you transfer it to PPE. When owner occupies a building, your land and building, right? So that's it. Then also, when the development starts for the purpose of selling it, you transfer it to inventory. You want to sell that portion, and that means you transfer it to inventory. IS 2, right? Then also, when you end an owner occupation, that is, owner was occupying it before. So which means before it was PPE, but now it is transferred to investment. Then lease to third party. When you lease it to a third party, that means you transfer from inventory to investment. Right? So that's it. Now, accounting treatment or reclassification. Please, if you have any question, don't hesitate to bring it on. Oh. Eh? So that's why you can see me pausing, Abby. So in case you have anything to say in between, please go ahead and say it.
Please, I do have. Oh, sorry for cutting you.
Go ahead.
This part of building leased out under operating lease, then you put even if vacant. Can you just expatiate a bit?
Which one is that, please?
The examples of investment property.
Oh, okay. Okay. Now, building that is leased out under operating lease, even if, let's say, your apartment, you have a building apartment, even if you don't have a tenant in that apartment, even if you don't have a tenant yet, you are still looking for a tenant. So far it is an operating lease, then you treat it as investment property. So when you build a house, you also be collecting rent on it. That's investment property. Are we there? Do you understand that now?
Yes, sir. Yes, sir.
I can proceed, Abby.
Yes, please.
Okay. Now the accounting treatment on the reclassification. You have to use fair value when, okay, now in your reclassification, if you are using fair value, then you have to revalue it to fair value at transfer date. When you want to reclassify, right? Now, when you want to reclassify and you are using fair value model, the date you changed it from being PPE to investment property, or from being investment property to PPE, it is that date you find the fair value. And the fair value, the market price as at that date, is the price you will recognize in the financial position as the cost of the asset, as the value of the asset. All right. Then also, if there's any gain and loss that is recognized, you put it in your PPE. All right. That is that. Now, the cost model is that you continue to depreciate it per IS 16. As per IS 16. All right. So that's it. Now, judgment and estimate. Now, for your judgment and estimate on IS 40, you need to identify the investment property correctly. Yes. And then you determine if associated assets qualify. That is, assets that are largely associated to it. For instance, if it is a land and you have a vineyard, if that vineyard qualifies for IS 40, then you had it. Then you select the appropriate accounting model you want to use. Fair value estimation can be reliable, and you can use fair value if the fair value estimation is reliable. Use fair value. Then you can use, change in use must be sustained with actual activity. All right? Change in use must be sustained with actual activity. So that's it. Now, IS 38 for intangible assets. Are we there? Are we there?
Yes, sir, we're here.
Yes, we are.
Okay. Now, IS 38 is intangible assets. Honestly, all these topics, you're not even supposed to go deep into it because you are aware, you know them already. All right. So I'm still using the idea that you know them already. Now, if you need anything I am not explaining, please make sure you say it. Oh. So that's it. Now, for intangible assets, they are identifiable non-monetary assets without physical substance. Now, apart from goodwill that every one of us know, what other intangible assets you know? What other intangible assets do you know?
Copyright.
Patents.
Research and development.
Research and development, copyright, patent rights.
Software.
Software. Software development, I mean.
Yes, sir.
Okay. Yeah, software development falls under research and development too. Okay, so that's it. Now, before you, when you want to recognize your intangible assets, of course, it must be identifiable. That is, it must be separated or it must arise from legal or contractual rights. Yes, and it must be controlled by the entity. And of course, it is expected to generate future economic benefit. Now, that is that. Now, the recognition criteria is that you recognize it only if there's probability of future economic benefit. One, then costs can be measured reliably. Two, the asset is identifiable and the entity controls the asset. Those are the four things. Now, for your measurement, initial measurement is at cost, right? Now, purchase goodwill. Inherent goodwill, how do we recognize it? Do we recognize inherent goodwill?
Sir.
Ma?
I didn't get you, sir.
Inherent goodwill. Inherent goodwill, how do we recognize it?
It comes as a under the non-current assets.
Inherent goodwill. I'm talking of the measurement now. Now, we don't measure inherent goodwill. We don't recognize inherent goodwill. Are we together,
Yes, sir.
please?
Yes, sir.
We don't recognize inherent goodwill. So what we'll do is that until it is purchased, that's when you recognize it. All right? Yeah, that's when you recognize it. We can
Yes,
move
sir.
on.
Yes, sir.
Yes, ma'am.
Yeah, what's the difference? How can you differentiate when a goodwill is purchased and when it is inherited?
No, I did not say inherited though. Inherent, not inheritance. Not inherited.
Okay.
Inherited is that someone gave you. I'm talking of inherent. That is, it is inbuilt. Inherent means it is inbuilt. So let's say, for instance, now.
Okay, I've understood. It was the word that was confusing.
Okay. Okay, I don't need to explain again then. You understand?
Yeah.
Now, so your measurement for intangible assets is always at cost. Whether it is purchased or it is acquired through exchange or it is acquired through government grants or it is acquired in a business combination, or it is internally generated. Now, this internally generated is the inherent one, which has a strict rule. Internally generated, you don't recognize it, all, right? It has a strict rule for recognition. Are we there?
Yes, sir.
So that is it. Now, subsequent expenditure is that you capitalize it if it increases the future economic benefits and it meets the recognition criteria. Are we there? Then, of course, your subsequent expenditure, most day-to-day expenditures, if it is day-to-day expenditure, then you expense it. Right? If it is day-to-day expenditure, you should expense it. That is that. Now, the means of acquisition and recognition guidance. Right? How to identify, how to recognize and acquire. Now, for the method, if you purchase this separately, you recognize it at cost, of course. If you acquired it, through exchange, you recognize it at fair value, unless where the fair value cannot be reliably measured. If you acquired it in business combination, you measure at fair value at acquisition date as well. Abby, you are familiar with that now?
Yes, sir.
You are familiar with that. Then, if it is internally generated, sometimes you recognize, sometimes, of course, there are strict rules. And the one you can generate internally that you can recognize, some of it is research and development. Right? Research and development. And that's what we have. Now, going into the research and development ones, you don't recognize goodwill if it is internally generated. You don't recognize brands, master aids. What is mast aid, which is a newspaper title. Publishing titles, customer list. You don't recognize them. Okay? And that's it. You don't recognize them. Now, you may be recognized, you can recognize development phase, right? You can recognize for research and development now that we said you can recognize is the only internally generated one, right? Now, you can recognize research and development at the development stage, and you need to separate the research from the development. Research is an expense. Development can be categorized as an asset. Development can be capitalized, and there are conditions before you can capitalize development. Are we together? There
Yes,
are
sir.
conditions before you can capitalize. So not just everything. Now, if all the conditions are met, what are they? Technical feasibility. If it is feasible that you will complete it, that you have the technical expertise to complete it, yes, you recognize it. Right? If you have the intention to complete it, you recognize it. Okay? If you have the intention to complete it, you recognize it. If it is capable of being sold, you recognize it. Are we together? If it is capable of being sold,
Yes, sir.
recognize it. Or you have it is capable of being used, you recognize it. There is probability that economic benefit will flow into the reporting entity, you recognize it. There is adequate resources to complete it, to complete that development, you recognize it. You have reliable measurement of the cost, you also recognize it. Those are the things that can make you recognize development. Are we together, please? Those are the things. Now, only costs incurred after meeting all the 6 conditions are capitalized. After you meet all the 6 conditions. The cost, not before you meet it, oh, after. So that's it. Now, we have business combination in process, research and development examples. Now, for business combination example, right? Now we have company X that acquires company Y. Company Y had spent 600,000 on research and development, not capitalized. Company X estimates the fair value of the research and development know-how at 500,000. Your treatment is that company X capitalizes it, right? Now, the fair value is 500,000, but the cost incurred on it is 600,000. X can capitalize the 500,000 as intangible asset. The post-acquisition research and development is that you have 150,000 expensed every year. Now, what's that expense? The depreciation. Do you understand? But you expense it unless new development criteria are met. That's when you stop expending it. Are we there?
Yes, we are.
Okay. Now, subsequent measurements can be either cost model or evaluation model. Cost model is cost minus amortization minus impairment. They don't have depreciation. They have amortization and impairment. Are we there, please? You can make use of a cost model where we have amortization instead of depreciation, right? You have evaluation model that can be used only if fair value can be reliably determined from the active market. So most times you use the cost model. And that's that. Now, all assets in a class must use the same model. I've said that before. Amortization of intangible assets. When you want to amortize, like depreciate, right? So you amortize it over its useful life, right? Which is a finite life. Then where it has an infinite life, no amortization but annual impairment test is required. When it does not have a finite life, that is, it has an unlimited life, unexpired life, right? Such an asset, yes, you subject it to impairment test only. There's nothing like amortization because it's not depreciating. And that's why it doesn't have a finite life. Now, this life of the intangible assets has to be reviewed annually. Yes, it has to be reviewed annually. Now, we have IS 18 judgment areas. IS 38, sorry. Now, the judgment area for IS 38 is that whether internally generated uh, intangibles meet recognition criteria. Are we there?
Yes, sir. We are here.
Okay. Now, so you can make a judgment whether the internally generated intangibles meet recognition criteria or not. You can use your judgment, right? Of course, you have to be unbiased. And also, you allocate value in business combination. Okay. Now, allocation of value in business combination. For you to allocate value to it, for that intangible asset, to know how much you are paying for that value, it is subjective, right? It's a personal judgment. Then, when you are forecasting future cash flow for impairment test, when you are forecasting it, you use your judgment as well. All right. Then also when you are choosing and reviewing amortization period, you use your judgment. When you determine if fair value is measurable from an active market. Are we there? So now you also need to determine if fair value is measurable from an active market. All right. So that's it. Now, for you to determine that, it is also subjective. And that's what we have there. Now, we have IS 37. Can we complete this IS 37 before we go? We
Sorry,
can't.
sir, please, I want to ask, these standards, do they have calculations?
Yes, they have calculations, but they don't have a standalone calculation.
Okay, sir.
Who has another question? Any question from anyone? Okay, let's stop it here. We'll continue from provision in our next class. Although I would have loved it if you guys can complete the chapter. Then someone will treat it for us. In our next class, someone will run us through it. And after running us through it, then we can go into the next chapter. All right. But of course, we have IS 37 for our next class. I'm hoping all of you can read. I don't want to do it as an assignment. If not, I was giving you to go and complete the chapter. All right. So that's it. This is where we stop tonight. If you have any question, please go ahead and ask. If you have any question, please go ahead and ask.
It's not a question, no, it's an appeal, sir.
Okay.
Hello, sir.
Go ahead, man.
Okay, sir. Please, I'm appealing if we can get a material with some examples on this that will treat less.
Okay. So the material, yes, I'll share the material with the management as usual. I believe the management already has this material, right? I've shared with them. Just go to Madam Christine, right, and get. Sorry.
With the locations on the calculation part of the standards.
So we will still solve calculation questions, but all these questions they are not standalone questions. But of course, we can see a question that will be standalone. That will stand alone on this PPE. We'll just ask you for the treatment. Yes, we have. So once we are done with this topic, probably in our next class, we'll look at those questions.
Okay, sir. Thank you, sir.
All right. Thank you very much, everyone.
Thank you very much, sir.